Daily, Managing Editor of AdvisorAnalyst.com. Joining me today is Sandy Liang, President of Purpose Investment Partners. Sandy, thanks so much for joining us today.
Thanks for having me, Pierre.
Sandy, I've got a bunch of questions for you. First of all, I want to set a pretext to my first question. Recently, S&P Global Ratings has said that the U.S. credit cycle has reached maturity. They say the current credit cycle in the U.S. has reached maturity, and we expect recent increases in borrowing costs, which began at the start of the year, to slowly continue over time. The firm's research analyst wrote in a report, at this point, we don't see any catalyst that would cause borrowing costs to spike or rise markedly higher at a subdued pace either. Credit markets are the financial system's early warning system in that they are typically the first to show signs of stress when they are falling apart. The fact that credit investors are relatively sanguine should be a sign that financial markets are probably more resilient than many realize. But as a follow-up, conflicting opinion, a recent op-ed piece in Bloomberg cites a number of research papers that point out that there's a correlation between rapid credit growth and heightened recession risk. For example, when junk bond issuance rises and spreads narrow, a credit bust often tended to follow 2 to 3 years later. Sandy, what are your thoughts on these conflicting ideas?
Well, Pierre, first of all, the business cycle is a business cycle, and a lot of investors are in the business of trying to forecast a business cycle because when you're fully invested in equities, that's how you get really hurt going into recession. You can be down 20% before you know it. The great thing about we do is that we're credit investors, so we lend money and we make a coupon off our investments every month. And so when you're in the credit market and you're a lender, the downturns are not nearly as severe. A typical downturn, even the high yield debt market, which is not investment grade rated, so we're talking single B on average, a typical downturn in the asset class is maybe low to mid single digit negative return in the depths of a recession. And in that context, as an active manager, we can tailor our strategy so we can go more interest sensitive and more defensive when we see a downturn coming. So with that as the context, I would say that right now we're principally invested in the United States, and as a corporate issuer, it's very hard to go bankrupt. The environment is still very accommodative. Real interest rates are pretty much zero still. And the economy, by all measures, is doing quite well. The U.S. economy has full employment. Sentiment measures, which is something we watch a lot because sentiment measures are actually leading indicators. Sentiment measures are very positive and really only became positive about a year and a half ago. So for perspective, sentiment measures in the last economic cycle peaked about 4 years before the recession and only went to below the median. They were actually a leading indicator in 2007, early 2007, so they were a pretty good early warning. So I guess to answer your question, we take the pulse of the economy and the business cycle all the time because when you're in equities, that's how you really get hurt.
Right.
And we have to do that because in the credit markets, you want to change your strategy. But right now, indicators, we don't even think are flashing orange. We think that in the U.S., indicators are flashing green.
Well, I guess to corroborate that, default rates have been dropping further.
Right. Yes. Default rates are very low. In fact, this year, default rates are among the lowest this cycle. And there's really, in the non-investment grade debt world, there's been one major bankruptcy, and it's a company called iHeart Communications, or
right.
Formerly iHeart Media, formerly Clear Channel Communications. And what does iHeart do? They are the largest operator of conventional radio stations in the U.S. And we all know that radio stations is a very tough business right now. It's traditionally ad supported, and people are listening to less and less of traditional radio. So it's not a surprise that a large company that is in the radio business with a lot of debt has recently gone out of business. So if you take that out of the default rate, defaults are very, very low right now.
Yeah, that seems like more of a sign of the times for radio.
Absolutely, and that's why as an investor, as a manager, we try to stay away from secular decline businesses because we find that if you stay away from businesses that are kind of in a long-term decline, you really skew the odds in your favor.